Hi, I'm Tekoa Da Silva with Sprott Global Resource Investments, and I'm sitting down here today with Mr. Rick Rule, CEO of Sprott US Holdings. Rick, good to see you again.
Thank you, Tekoa. Pleasure. Thanks for organizing this.
Very happy to be sitting down with you with a subject that I've been looking forward to speaking with you about, and that is the work of Ben Graham, Security Analysis, how it has impacted you in your career. And with us here for this discussion are two of his great works, The Intelligent Investor and Security Analysis. So to start with, Rick, I've heard it said that Graham's work, The Intelligent Investor and Security Analysis, it may be viewed as a series of scriptures, a Bible, if you will, for the investment profession. If that's correct, how impactful were these books on you, and what was the discovery and the excitement like when you found them for the first time?
Well, The Intelligent Investor absolutely changed my life. My career intention when I was a young man was that I was going to be an international taxation lawyer in natural resources. I know that sounds pretty boring, and in fact it would have been had I pursued that career path. Hard to believe now, but I was a very earnest young man, and I found a very good tax lawyer, and I said to him that if I paid him I asked him if I paid him his hourly rate, would he give me career consulting? He agreed, in fact, to do it for the price of lunch. And I discussed my career path with him, and he sort of laughed and said, you know, if you make it through law school, which you will, I'll hire you, and you'll be miserable. I don't think you should do it. Because you're an independent businessman, I think you'd be a great investor. And there's an investor here in town who really likes you. His name is Peter Cundall, and you should visit with Peter Cundall. Peter Cundall, unbeknownst to me then, was already a legendary investor. So, given that I paid for the advice, I had the good sense to listen to it. I met Peter Cundall, and he gave me a copy of The Intelligent Investor. He said, read this and call me back on Tuesday. And I didn't want to read it. You know, that isn't what I wanted to do. I wasn't looking for advice, really. I was looking for affirmation. I wanted them to tell me I'd be a great lawyer. And I decided, well, I said I'd read it. So I opened the book, and I was 10 pages in the book, and my life was over. I didn't put the book down. I read it. I read it in one sitting. The next day, I began the process of reading it again. And that book changed me from a course of being a miserable tax lawyer, maybe in fact a felon, and made me an investor. So I can say absolutely positively it shaped my life. In addition to that, coming into investing with a philosophical grounding in what investing is really about, as opposed to coming into investing like most young men do, purely greed and larceny, trying to make money without deserving it, was useful to me. Now, it must be said, Tekoa, that within my first decades as an investor, I violated every rule that I learned from Graham. The consequence, though, of having understood, as you would put it, the Bible at least according to Mammon, is that I came to understand the rules I had violated, and I understood why I paid the penalties for violating them, something which doesn't happen to many young men.
Rick, let's talk about a theme from Graham's work, price versus value. In a simple way, how can we understand those two ideas, and how do they interact with each other?
Price is what you pay, value is what you get. Prices are ephemeral, and values can be ephemeral too, depending on who. But the truth is that people rely on price information and they conflate it with value. People pay attention to the price of a stock because that's easy to assimilate information. You can get it from your computer, you can get it from the paper, you can get it from your broker. It's easy. And it represents to you, second by second by second, affirmation or denial of the so-called worth of the investment, but more importantly, probably the worth of you as an investor. Value is very different. It's hard to get. You have to work for it. But the truth is that making money in either investment or speculation, they're very different disciplines, as you know, involves exploiting the arbitrage between price and value, buying things at a price below or substantially below either their current value or the value that you think that they're likely to attain over time. And in addition to having the courage to buy low, because it normally does take courage, having the wisdom, in fact, to sell high. One of the things that happens is if you make an investment, an intelligent investment, where the price is attractive relative to value, and the price of the investment escalates, there is a sort of a self-enforcing tendency to come to believe your thesis for more than it's worth. So the difficulty in the sort of arbitrage between price and value occurs both on the buy side and the sell side.
What about the ideas, Rick, of investment versus speculation? How do you view and define those two ideas, and how do they interplay with price and value?
My definition is different than Graham's, and I think my definition is better because Graham was never a speculator. And so I believe that empathy is more sincere than sympathy, and given that I'm a speculator too. I would say that investing is an activity engaged in where you are employing capital in the expectation of a certain return, hopefully a good return. Speculation is an activity where you are hoping for an excess return, but you understand that you might not get a return of some or even all of your capital. Investing involves the expectation of a return. Speculation is very different.
If we look at price, if we change price on an underlying asset or a business, if we move price up or down, can we go from investment to speculation? What are your thoughts there?
I think it's less likely, frankly. I think it involves the progression of the underlying entity. A company itself can move from being a very speculative activity to being an investment grade activity. Different classes of security within the same company can be either speculative or of investment quality. And there are some investments that are sort of on the cusp between investment and speculation. As you know, Tekoa, in addition to being an equity investor in the resource space, I'm a lender. If you look at the years between 2011 and 2015, equity prices on the Toronto Stock Exchange Venture Index fell by 90%, while the return that we got in lending to those same enterprises over the same period of time was 18% compounded. Now, I'm not trying to say necessarily that lending to companies with no visible means of repayment is an investment quality activity. These were certainly sub-investment grade companies. But making well-secured loans to companies rather than investing in the equity of the company is certainly more of an investment style activity than speculating in the common equities.
Thinking about the cyclicality of stock markets, what types of price to value setups are common to see during bear market bottoms based on your experience? And then what price to value setups are common to see at bull market tops?
Well, Graham and his most noted student, Buffett, talked about the sixes. And let me see if I can remember the sixes. Oh, yes, I do, as a matter of fact. 60% of book, 6 times earnings, and a 6% dividend yield. Now, in today's climate, hoping for the sixes is like hoping for a nasty weekend with 6 of the best models from Victoria's Secret. It's something you would hope for with no expectation of satisfaction. But that will give you a sense of what Graham and Buffett were able to accomplish in the 1950s and 60s when equities, particularly value equities, and particularly small capitalization value equities, were out of favor. There were extraordinary transactions. In our own sector, Tekoa, when you joined us, I remember pointing out to you public companies that were selling at discounts to net cash, meaning that the market capitalization of the company was less than the cash in the treasury, and you got the assets in the company for free. Those are not uncommon circumstances when equity's out of favor. In fact, still, there are small capitalization companies, generally fairly obscure, very thinly traded, fairly unknown, that are cash flow positive companies that are selling at discounts to their net working capital. Ben Graham referred to those as free bonds, meaning that because you bought them at a discount to cash, their cash flowing activities were free to you. That's an example of an extraordinary value. An example of a bull market peak might be uranium stocks in 2006, when the uranium price had already gone from $8 to $130 and didn't need to go higher, when the population of uranium juniors went from 5 to 500. And that number is instructive in terms of value, 500, because there were probably 15 competent management teams that survived the bear market. So the probability that your speculative uranium junior had a good management team was a simple function of dividing the number of teams, 15, by the number of companies, 500. A speculation that's entirely driven by the narrative, a popular narrative, not driven by arithmetic, is the circumstance that you see in market tops.
What kind of underlying value do you recall seeing during that time in the uranium market across those 500 companies? We had price here and then value here. Was it really just a cloud in terms of value?
I think a cloud is generous.
Yeah.
I think it was a population of lies. Probably 400 of the uranium juniors were populated by managers, underwriters, and investors who 5 years prior hadn't been able to spell uranium. The truth is, when the uranium price was at $8, it was very clear that it was going to go to 30 or 35, because that was the cost of production of uranium. And if the price didn't go up to the cost of producing uranium, we wouldn't have electricity. So when the price of uranium had to triple, nobody wanted to own it. When the price went to 130 from 8, and it cost $75 a pound to make it, in other words, when you had 50% operating margins, and the price didn't have to go up, everybody wanted to own it.
Rick, during your life experience, have you encountered any individuals that in the real economy practiced arbitrage between price and value with physical things that were simple that anybody could pick up and do, whereas we're talking about securities now?
Sure.
But what about on the street? How can the
Absolutely.
average guy do that?
Absolutely. We have a client in the firm who I think is known to you. He's known to many of our clients. Van Simmons is his name. Van Simmons is known professionally as a rare coin dealer. But the truth is that Van will trade in anything. And Van has an encyclopedic interest in physical goods. For the right price, he'll buy a stuffed polar bear. He'll have a sense, somebody will pay me $10,000 for this polar bear, and it's in this garage for $800. I like this polar bear. I'm going to buy it. He has a pocket knife collection. I don't want to talk about some of his other collections, but certainly there are people who understand the arbitrage between price and value in assets that aren't financial assets. There are people who can look at a single-family home for sale and understand that with several functional or cosmetic changes, that they can change the value of that single-family house without a bull market in single-family real estate. They're not playing the single-family market. What they're doing is understanding that there's some aspect of that asset that isn't appreciated by others that they can develop and change the value. In fact, an entrepreneur does that instinctively. An entrepreneur sees a hole in the market, a good or a service that's required that he or she can fulfill and make a profit. So in fact, you can arbitrage between price and value even in an idea.
So it could be starting out something as simple as used goods, a yard sale, and if the person wishes, they could move on to something like security analysis and practice the same thing?
Certainly. I was instructed to get into the investment business because of my prowess as a very young man as an entrepreneur owning restaurants and bars. It was my ability to take a failed hospitality establishment and make it successful, understanding why it was failing, how to make it successful, and how to market it, that caused Peter Cundall to say, you understand business, so you can be a good investor. So in my own particular case, there's an illustration of what you describe.
Rick, as a final question, is there anything you think we may have missed?
Well, it does draw one observation out of me that is useful, and that is that the most important asset that you'll allocate in the course of your career, yourself or anybody watching this, is themselves. Investing in their education, investing in their discipline, investing in their skill set. Knowledge is an interesting asset. It can't be stolen from you. If you organize your life correctly, it's tough to tax, and it can pay extraordinary returns. In the same sense that you talk about arbitraging between price and value with regards to physical or financial assets, the greatest return on employed capital is probably investing in your own skill sets and your ability to deliver utility for others, whether your product is a good or a service. And people need to invest in themselves before they invest in anything else, and through the course of their career, in favor of investing in themselves, rather than investing in areas that are more distal to their ability to perform.
Rick Rule, CEO of Sprott US Holdings, thanks for sharing your comments with us.
Always a pleasure, Tekoa. Thank you for making it possible.